Okay, so once we select the directional option trade, then we have 3 trade management rules. We exit our losing trades quickly before they turn into large losses, and we don't exit winning trades with a small gain. And I'll show you how we don't have to exit our winning trades with a small gain because we'll create a spread. So, and then the third rule is we use options to protect any profits that we have on winning trades. So the trade management is just as important as the trade selection. You want to exit a losing trade quickly, and if the trade works out and you have a profit, then you want to use options to protect those profits. Here's a snapshot of some recent closed trades that we took. And this column right here lists the profit we had for the trade, the profit or loss that we had for the trade, and here's the second part of that snapshot. So this column right here, the column on the left, of course, has the stock, the strike price, what we opened the transaction at. In this case, we bought the LNG 40 strike call at 1260. We closed it out at 2410. We had a $6,882 profit on this. So what I did was I tallied up the losing trades in those closed out trades and compared them to the winning trades, and to demonstrate that you don't want to exit or you want to exit losing trades quickly before they turn into large losses. So in these examples, in these 2 snapshots here, our average losing trade was 14%. So we'll look to get out of an option trade. If we get up near a 20% loss, we'll exit. We were wrong, and we will simply exit before it develops into a large loss. And in this example, we exited, and the average loss was a 14% loss. So by not exiting winning trades with a small gain, we had an average winning trade in this example of 136%. So we had an average losing trade of 14%, and we had an average winning trade at 136%. So that's why you don't want to exit your winning trade with a small gain, because the winning trades can mitigate your losing trades. And for example, we only had to win on 1 out of every 8 trades in order for the portfolio to profit. So this is an example of why we don't exit with a small profit, because we want to hold on to the option and get a big winning trade. And if you do that, then you don't have to win on that many trades in order for your portfolio to profit. So we exit quickly with losing trades and hold on to winning trades. And of course, if you incur a 20% loss on your option trade, it takes a 25% return on the next trade to break even. If you incur a 50% loss, then your next trade you have to have a 100% win in order to break even. So how many 100% wins have you had lately? So we always exit losing trades quickly, 20% or less, and then hold on to the winning trades. And here's an example. This is this is a snapshot of open trade profits. We have 2 accounts. This is my larger retirement account, and this column lists the option that we bought, the quantity, the price we paid, the last price, and then our dollar profit and percent gain. So this is just an open trade snapshot. This retirement account had a $961,000 open trade profit using Prime Trade Select and my smaller retirement account had a $247,000 open trade profit. So those trades were selected using Prime Trade Select. So Prime Trade Select has produced a lot of winning option trades, and whenever you have a winning trade, you always face that dilemma, well, should I get out in case the stock goes down and that winning trade turns into a losing trade? But then if you exit a winning trade and the stock keeps going up, then you leave profits on the table. So we solve that dilemma by simply buying a put option to protect our profits. And we know that as traders, it's very hard. If you have a winning trade and all of a sudden it turns into a losing trade, it's hard to stick with your program, because it's hard on your psyche as a trader, and you could lose confidence in your ability to be a successful trader if you let a winning trade turn into a losing trade. So we simply buy a put option to protect our profits. And the put options, of course, profit if the underlying stock declines in price. And whenever you have a winning call option trade, purchasing the put gives you insurance against a loss on your call option in case the underlying stock declines in price. Now, at the same time, purchasing a put option does not limit your upside profit potential of the call option if the underlying stock continues to rally in price. So that solves that winning trade dilemma. You're locking in a profit, and if the stock continues to go up, you don't have a cap on your upside profit potential. So again, this allows us to use our money management rules, and it's been working out very well, especially in choppy markets like we've had the last couple of years. So by purchasing that put option, you can even guarantee that you'll have a profit on your call option, and I'll show you some examples of that. So once you buy that put option protection, you can forget about the trade until option expiration. You don't have to monitor the markets or world events. You don't have to place a protective stop in there. Once you buy the put option, you can forget about the trade until option expiration. So bad earnings reports don't matter. Severe sell-off in the markets don't matter, because once you put that protection in place, then you can just forget about the trade. So when you have a winning call option and then you buy a put option, we call this a market neutral spread, because the call option, of course, profits if the market goes up, and the put option profits if the market goes down. So we call this a market neutral spread, and it's a very low risk way to trade options. And again, if we have a losing trade, we simply exit that losing trade and move on to the next opportunity. If we have a winning trade, then we want to protect those profits by buying a put option. And these market neutral spreads can profit if the price of the stock goes up or down. And a sharp decline in the price of the underlying stock can actually result in a windfall profit with these market neutral spreads, and I'll show you some examples. And your total risk is limited to the cost of the spread. Okay, let's look at some examples of market neutral trades. We use Prime Trade Select to purchase a Home Depot call option. We got a low risk entry using the Keltner channels. We used the 1% rule for selecting the strike price. That produced a profitable trade, so we legged into a market neutral spread in this trade by buying a put option. So here's a portfolio snapshot that shows that we bought 45 of the Home Depot 80 strike calls at 10.15, and that produced a $120,000 profit. So what we did is we purchased a put option on this, and we usually purchase the put options maybe 2 to 3 months out, and then when that put option expires, then we just roll over into a new put option for protection. So in this example, we had $120,000 profit, and we the put option protection we had in place was expiring, so we went ahead and bought the 110 strike put option at 420. So this shows that we bought 45 October 110 strike puts at 420. And here's a snapshot. Open trades at the time. We bought 45 80 strike calls at 1015. We bought 45 110 strike puts at 420. And we have a calculator for these market neutral trades that will calculate the profit potential for the spread, assuming various price changes in the underlying stock at option expiration. So here's the market neutral calculator, and again, this is for Home Depot. The stock was trading at 115 at the time. We bought the 80 strike call at 1015, and then we legged into the 110 strike put at 420. So in this example, the calculator will calculate the profit potential from a 30% increase in the underlying stock at option expiration to a 100% decline. Now, of course, we don't expect a big decline in a stock like Home Depot, but I just put this in here to show you how this market neutral spread strategy works. So let's look at in this column right here, if the stock is flat at option expiration at 115, we'll have a $2,082 profit and a 145% return. If the stock goes up 10%, we'll have a $3,200 profit and a 225% return for the spread. Now, if it goes down 40%, which I would not expect it to do, but you can see that if the stock takes a severe dip, you're still going to profit. In this example, if the stock went down 40%, we'd have a $2,600 profit in the spread and a 185% return. So in this example, we were able to lock in the minimum profit in this example would be 145%, and that's if the stock was flat at option expiration. So in this example, we had a guaranteed profit of 145% return for this trade in Home Depot. Here's one more example. This is for the healthcare ETF, symbol XLV. We own 64 of the January 50 calls at 960. We had a profit in it, so we legged into a market neutral spread by buying the 75 strike put at 4 points, and we bought 64 of the January 75 puts at 4 points. And here's the market neutral calculator for this trade. And if the XLV was flat at option expiration, we'd have an 83% return. If it was up 10%, we'd have a 110% return. And if it was down 40%, which I would not expect, we would still profit on this trade. And notice how with these market neutral spreads, it doesn't put a cap on the profit potential. So if it's up 10% at expiration, we have 110% return. If it's up 20%, we have 162% return. So these spreads don't put a cap on your profit potential. And at the same time, if the underlying stock or ETF goes down, you can still profit. Okay, here's a snapshot of a portfolio of market neutral spreads. This is for Cigna, Costco, J&J, Starbucks, Wells Fargo, and Yahoo. And this is the open trade snapshot. In this column here, lists the profit, the open trade profit for the option and the percent return. So this was a portfolio in one of my smaller retirement accounts, and what I did was I used that market neutral calculator to calculate the profit potential for each one of these trades, and then I combined that into how the portfolio would do as a whole. So I used the market neutral calculator, calculated the profit potential for these trades, and here's what we came up with. If the stocks in this portfolio, the underlying stocks, if they were flat at option expiration, this portfolio would have a 277% return. If the stocks on average were up 10%, then we'd have a 711% return for the portfolio. So this is the portfolio, the total portfolio, and these would be the average returns. And if the average stock went down 20%, then we'd have a 1,200% return. So this is just demonstrating that if you have a portfolio of market neutral spreads, what the return potential can be. So again, with this portfolio, we're guaranteed a profit by buying those put options, because you can see the minimum return that we get for the portfolio is 277%. So the strategy this is a great way to invest in options, this market neutral strategy. It's very low stress, very low risk. So we like to use this strategy, and if you have a highly leveraged option portfolio of directional trades, a sudden market decline that you didn't expect could wipe out that portfolio profits quickly. So we've seen too many times where we had a call option portfolio, and we had nice profits in it, and all of a sudden there was a sudden market decline, and we didn't have that put protection, and then all of a sudden those profits turned into a loss. So that prevents these trades from turning into a loss by simply buying the put option to protect them. Okay, again, a very low risk, low stress way to trade. So this is one of our favorite strategies, the market neutral spreads, where we leg in to the spread by buying a put option. And that portfolio I showed you previously with the 6 market neutral spreads, if you bought just one contract of every one of those call and put options in that portfolio, the total cost would have been about $1,715, and that's after commission. So you can trade these market neutral spreads in smaller accounts. And what I'm going to show you lastly here is our closed trade profits, recent closed trade profits of $1.9 million. And these trades are a combination of prime trade select directional trades and market neutral spreads. So for Apple, we had $356,000 in closed trade profits. For the financial ETF, the FAS, we had $426,000 closed trade. Home Depot, $296. Netflix, $23,000. TJX, the retailer, $35,000. And the Nasdaq ETF, the triple Qs, we had $590,000 in closed trade profits. So you can see these strategies have been doing pretty well. The healthcare ETF, we had $221,000 in closed trade profits. Okay, so we have an advisory service, and we make trade recommendations for our option strategies. And what we do is we send out an email if there's a new trade recommendation to enter a new trade, and we also send out an email if we're closing out a trade. So we put the new trade in the open trade portfolio, and then each day the prices are updated real time so you can see how each trade is doing. And then we also, every time we close out a trade, we maintain a closed trade portfolio so that we account for all the trade recommendations that we give out. So if you want to see how, you can see we have several portfolios here in the weekly option advisory. And if you want to get an idea how these portfolios are doing currently, if you go to weeklyoptionalert.com and you click trade results, you'll see how these strategies are performing. We have both the open and closed trade results if you click trade results right here. So if you're interested in the advisory service, you can call Brad at 866-661-5664 or 310-647-5664. So, or log on to weeklyoptionalert.com if you want to get further information on the weekly option advisory. So that concludes my presentation, and I'd like to take questions at this time.
All right, we have a few.
Okay.
We have quite a few that have come in, and a lot of them I was answering the ones I could, like how does this work in Metastock and that kind of stuff. But let's just kind of take a few. I don't think we'll get to all of them. Do you so let's just say this: if people have questions that aren't addressed, would their best bet to be to call Brad to talk to him about it?
Yes, yeah, they could call Brad, or if you log on to the website, you can also send us an email. Just click contact, and it'll give you an email address, and you can certainly send us an email, and that goes to my sons that work with me, and we will get any questions answered.
We'll start with an easy one. Keltner channel. You pretty. I believe based on kind of the looking that I did, you're using a 20-period Keltner channel. Is that correct?
Yes, I use the default channel. Yes, that's correct.
Anna, I just answered your question for you. I didn't want to type that as an answer because I hate it when I type something and it turns out wrong. So I was just kind of curious. I was pretty sure about that answer though. So Mike asks, will it work for a very small account? I mean, a total cost of a trade that is about $100, not like $1,200 like Apple.
Oh, you mean a total account of $100?
No.
The
trade size of $100.
Oh, yes, you could. In that portfolio I showed you, there was 6 spreads, so that's 12 options, and the total cost was $17.15. So they were just over $100. They're about $150 on average for one contract for that portfolio that I showed you the snapshot of. So you could do it with $100. Probably realistically, it would work better if you could spend $300, $400, $500 on the option, because don't forget, you're going to be buying an in-the-money option initially before you leg into the market neutral spread. So those in-the-money options using the 1% rule, they're going to be more expensive. So realistically, you would pay probably closer to $500, $600 on those in-the-money options.
Okay, and yes, Annie, 20 for the Keltner channel. So that same question came in again, so I guess we weren't clear. What is the average trade time for you, Chuck?
That's a good question. We normally go 2 to 3 months out, and now on the call purchase, we can go further out, maybe 3 or 4 months. But when we buy the put option, that's usually 2 to 3 months out, the protection. But we're longer-term traders. We don't follow the market closely. We just check our portfolios once a day, and we're longer term, and we go out several months on these trades.
Okay. Awesome. There was one more that I was seeing that kind of seemed like we could kind of take a stab at it. Um, I kind of lost it though. How do you determine the ratio? Robert asked this question. How do you determine the ratio number of puts needed to protect calls in a winning trend?
Oh, it's a simple one-to-one ratio, because with the call option, that covers 100 shares of the stock, and the put option covers 100 shares of the stock. So it's a simple one-to-one ratio.